Hey guys, welcome back to my channel. Since it's the end of the year, let's continue to do the end of the year market. So for today's video, we're going to dive into the CCR. So for the flow of the video, it'll be as such. We'll go through the 2025 new launch, the PSF, the take-up rate, what it says about the demand in the CCR. Then we go into 2026, where we go through the supply, the possible new PSF and benchmark, and how it affects the CCR market. Followed by what it means in the resale market too, with all the new launches setting all the new benchmarks and the PSF, what could the impact look like? And finally, we'll conclude with some things to look ahead and things that you might want to prep for in 2026. Okay, so for those who are unsure what and where CCR is located at, CCR stands for Core Central Region. This is where you find the most prestigious central areas for real estate in Singapore. So it encompasses the prime districts such as like Orchard, District 9, Bukit Timah, District 10, Novena, District 11, and so on and so forth. So it's really known for luxury homes, high value land, and the proximity to those CBD areas. So in other words, this is where all the atas people live lah. So now that you know where and what the CCR is, let's go through the events that took place in 2025. So let's go through all the new launches in the CCR that happened in 2025. First with Robertson Opus, a 999-year leasehold. This is a redevelopment of an existing condo with an average PSF of 3360, where 41% units were sold during the launch. But as of now, I believe more has already been sold, where the 4 bedrooms are completely sold out, and then a handful of 3 bedrooms are still available. Majority of those remaining units are actually the 1-bedders and the 2-bedders. Next, we have Upper House at Orchard Boulevard, with an average PSF of 3350, with a 54% sold out rate during the launch. This project was particularly popular amongst investors because the direct access to the MRT and a close proximity to the CBD, where the top selling units were the 2 bedrooms plus study, which 60 out of 67 were sold during the launch. Moving on, we have 21 Anderson, an ultra luxe development with an average PSF of around 4750, even though there's no news about the sold out percentage, but roughly 7 units has been sold out of the 18 in total. So here's the rough gauge of the quantum of the development. The 2 bedrooms come in at 10 million, 4 bedrooms come in at 20 million, and the penthouse comes around 58.6 million. So this is really for the ultra wealthy, high net worth people. Not your typical luxe project, but an ultra luxe project. Next is Aurea with an average PSF of 3005 that sold out 23 units out of the 78 units during the phase 1 launch. But after the second phase of the launch, I believe more units have been sold out at this current point of time. And with an average PSF of 3005, it won't be surprised if more units will be sold out, because in the CCR, this is the next lowest PSF you can find. The lowest will have to be Sky Holland with an average of 2953 PSF that resulted in the 99% sold in the first weekend launch. So this is super crazy and super hype. So this is one of the most hyped projects in 2025, and for good reason. The location was good, convenience was amazing, right beside One Holland Village, a short walk to the MRT, and amazing eateries. Even though they didn't have like a tennis court or full facilities, amenities, it didn't matter because the pros outweigh the cons. Then we have W Residence at Marina View that recently had its public launch in October this year, where there was a release of 100 units for sale in the first phase. According to the article, only 2 units were sold from the launch onwards, but a few more had been reserved. So this project is a fully integrated branded development, meaning to say it comprises of both the hotel and the residence under one roof, which is the first ever in Singapore. So last we have Rivergreen with an average PSF of 3130, an impressive 88% sold out rate during the first weekend launch. The reason why it did so well was similar to the reasons of Sky Holland. The location was good, convenience was good, and the entry price was good for its location. So another trend you want to take note of is the demand for bigger unit size in the CCR location, where many of the 3-bedders and the 4-bedders actually sold out first before the 1-bedders and the 2-bedders. So this actually shows that the families are actually coming back into the CCR. The demand in the CCR for bigger and growing families are increasing. But why is that so? Well, there are 2 train of thoughts that I can think of. The first one is the price gap. The price gap between the CCR and the mass markets, being the OCR and the RCR, is getting narrower. So with this narrowing of price gap, it allows for this social advancement, meaning to say that the bottleneck from people to upgrade from the RCR to the CCR gets a little bit more reachable. So with that, families say that they don't mind topping up a bit more so they can upgrade their address to the CCR location. Another train of thought is the livability of the projects in the CCR is actually improving, where you can see that majority of the external outdoor spaces are getting smaller, even though they still provide, but it's less excessive. And also the layout of the balcony, the odd shapes of the balcony, they're starting to reduce the fancy designs and make it more practical, more regular, in the sense where they can actually box up those balcony spaces to use it into a livable internal space. So these are just some of the signs that the demand for the CCR for families is actually growing, reason being because of the livability factor and also the affordability factor. Hence why most of the bigger units are actually sold out. Alright, so that was the CCR new launch for 2025. Now let's do a quick comparison of the previous launches with a similar location to give you an idea of the appreciation and the PSF difference of the same location. So for Robertson Opus, the average PSF was again 3360, but previously Union Square Residence, launched in 2024, had an average PSF of 3200 PSF. But do take note, this is a 99-year lease. Then for Upper House, the average PSF is 3350, previously Cascadian Reserve. So this is a little bit interesting because the official launch was in 2019, where the average PSF was 3625. And the project was actually completed in 2023. But in 2024, they had a relaunch where the PSF started from 2900 PSF. The reason for lowering the PSF and relaunching it again, according to the article, was due to the ABSD deadline, so they had to sell all the units soon, if not they would incur additional costs. So does that mean that this was a bad project? I would say it's a mixture of both bad luck and also wrong entry price. Because in 2019, their average PSF was 3600, even for today's market, it is 300 PSF above valuation, so imagine back in 2019. Also, they were hit with a cooling measure in 2018, which really reduced their buyer pool. I believe that part also played a significant role in affecting the project. So again, this shows the importance of the entry price and also the land bid price, because the land bid for Cascadian Reserve was the highest bid ever made in Singapore by a developer. At 2377 PSF PPR, that's crazy. That means that their break-even will have to be around 3200 PSF, and this was back in 2019. So that really played a factor of the sales of the units in Cascadian Reserve. Next is 21 Anderson. The average PSF is 4750, previously Walton House at 3230 PSF with 180 units. So 21 Anderson only had 18 units, so hence the big difference in PSF because it's categorized as a luxury exclusive development. Then moving on, we have Aurea, average PSF of 3005, previously Midtown Modern at 2800 PSF. Then W Residence at 3230 PSF, previously Marina 1 Residence at 2750 PSF. Next we have Sky at Holland, average PSF 2953, previously 1 Holland Village Residences at average of 2600 PSF. And lastly we have River Green at 3130 PSF, previously Irwin Hills Residence at 2690 average PSF. So with this, you can actually see the difference of the PSF in the location itself. So the question is, what is the common trend? Common trend is actually the difference is actually in the mid to low 3-digit number. But if you compare that to in the RCR market, you see something very interesting. So in this slide, you can see the difference in the RCR market. The difference in PSF is much wider compared to the CCR. Penrith in 2025 average was 2800 PSF. Sterling Residence in 2018 the average was 1800 PSF. So the difference is a lot larger. Another example, Ori in 2025, average was 2700 PSF. Gem Residence launched in 2016, average 1426 PSF. Lindenwood in 2025, average was 2450 PSF. Momentum Park in 2021, average 1750 PSF. So what this shows is that the RCR market is actually appreciating faster than the CCR market. But the question is, why is this so? I thought the CCR is supposed to be like the most prestigious, the most like atas area. Why is it the appreciation is slower than the RCR? Well, if you want to know more, you can actually watch my previous video where I dive into detail as to why this is happening. But if you're lazy, let me just give you the TLDR, yeah? So it's actually due to two things. First, the demand. The demand for the CCR wasn't as good as the RCR, reason being is because the livability in the RCR was way better than the CCR, meaning to say that the layout's more efficient, there are more practical internal spaces, less excessive outdoor spaces compared to the CCR. And because the CCR spaces was not as efficient as the RCR, the quantum that they have to pay is significantly higher, where the 3-bedroom in a CCR could actually be a 5-bedder or 6-bedder in an RCR. So this really used up a lot of unnecessary space, which really reduces the livability of the home in the CCR. Hence, that's why the demand for the CCR was not as popular amongst the families compared to the RCR. Second is the transformation potential. Because CCR is more of like a mature estate or region, there is not much space left for a transformation to occur as compared to the RCR or even the OCR. But there's space still available where transformation can occur. That means there can be more GLS plots in the RCR compared to the CCR. There can be more transportation interchanges or transportation nodes in the RCR compared to the CCR. And also, the time taken for the transformation to occur will be much faster than RCR, where they just have to build it up, compared to the CCR, where they might have to tear down the development, then build it up again. So that's why the RCR has more transformation potential compared to the CCR. Let me just give you an example. The Gardens at Bishan. It was a good condo with good amenities and also good schools nearby, so it was already appreciating well. But because they had a transformation of an MRT nearby, that really skyrocketed the appreciation of the property. But the chances of this happening in the CCR is much lesser than RCR. So just a food for thought for those who are investing. Would you prefer the RCR or actually the CCR? Let me know in the comments below. So in this next slide, I've compiled all the new launches in 2025 together with the take-up rate during the launch date. But do take note that some of these projects, more units has already been sold, so the take-up rate percentage has increased. But in total, the new launch supply in the CCR for 2025 is 2,728 units. So remember this number as we see how it will impact the demand of the CCR market. But before that, if you'd like to see the remaining units of these projects, including those in the RCR and OCR, you can contact me through WhatsApp at 93690713, where I can do a full analysis of what are the units left and whether the unit suits you. And not just new launches that occurred in 2025, but those in 2024, 2023, and 2021 also. Okay, so going back to the analysis, the total units of 2025 is 2728. So now let's minus off the transactions made in 2025 from those new launches that occurred in the same year. That will be 1,576 total transactions made as of 18 December 2025. There will be a total of 1,576 transactions. So let's take the total supply minus the total transactions. That will leave you with 1,152 units left, giving us a 57% take-up rate. And for context, you can refer to the table below to give you an idea of the market interpretation based on the take-up percentage, which, as you can tell, sits in the healthy demand range. But knowing the demand for the single year doesn't mean anything. We need to understand why is that so. And for this to occur, we need to evaluate based on the previous year's data too. So let's do a cross-reference to the previous years and question ourselves, has the CCR market always had this healthy demand? And how does it impact the future in the CCR? Over here, I've compiled the total supply and the transactions of the previous years all the way to 2021. So in 2024, the supply was 680, not a lot, and despite the little supply, there was an even lower transaction volume, making the take-up rate 18.5% only. Similar in 2023, the supply was around 630, but the total transactions was a bit higher at 381, making the take-up rate 47%, which was considered a moderate demand. Then back in 2022, the supply was 1473, transactions was 510, take-up rate about 34%, moderate. Then in 2021, supply was 2691, transactions was 1430, the take-up rate 53%, a healthy take-up rate. So now we know the demand and the supply of the previous years and also the take-up rate. Let's dive into why this occurred. So in this next slide, I've actually done a timeline for the ease of understanding the history and how the history actually impact the demand and the supply of the CCR. So as you can see in the timeline, before 2020, the homes were very underutilized. It was just a place for you to sleep and rest. But when COVID hit and there was a lockdown, homes became more than what it was. It became an office, it became a classroom, it became a gym, and more importantly, it became a safe asset. So the demand to upgrade into a bigger space increased significantly. That's why we have a surge in the property market in Singapore. The prices were high and the transaction volumes were high, and this was amplified by the lowering of interest rates, which back then was a record low. The reason for the interest rate being so low was actually a central bank's strategy to stimulate the economy, resulting in Singapore's mortgage rates dropping to around 1 to 1.5%. So this allowed people to over-leverage to a certain extent, making it cheaper to borrow money for a large sum. So the demand was high and supply could not keep up, thus the prices increased. So then when the prices increase too fast, what do you think the Singapore government will do? In order to stabilize the market, in 2021, they had cooling measure, a higher ABSD, where the second property for Singapore citizens was raised from 12% to 70%, then for foreigners from 20% to 30%. But as you can tell from history, this was not effective because the locals and foreigners still saw the value and benefits of investing in a property despite the cooling measure. And even the developers understood this, so there was an increase in supply in 2021. More particularly, properties in the CCR, because the foreigners saw it as a safe asset. So much so that even in 2022, the overall supply dropped, but in the CCR, it had the smallest drop percentage compared to the RCR and the OCR. And the developers understood this, that's why they still supplied properties in the CCR. But the biggest measure was done in 2023, where the ABSD increment was the most painful for the foreigners, a 60% increase in ABSD from the previous 30%. That's why you can see the supply and the transactions in the CCR took a huge dip. So in this diagram, you can actually see how the occurrence of the events affect the pricing of the market, especially in the CCR. Where you notice the years of the CCR, the take-up rates were not so high, the prices were also appreciating very minimally. Where you see one of the reasons is the number of foreigners investing in Singapore property has reduced by a lot. Where in 2021 there was about 540, now in 2025 it's reduced to 30. A huge drop in the foreign demographics, especially in the CCR. So if you take this fact that the foreign demographics is decreasing, and if you keep up the real estate market, you realize that the CCR demand is increasing. This means that the demand is coming from the locals. There is a local demand rather than an external demand. And having a local demand is always more stable compared to relying on external demand such as the foreigners and the PRs. Because the foreigners who invest in Singapore, they have less liability in Singapore compared to the locals there. So if anything was to happen to Singapore's market, who will be likely to move, pack up everything and just leave Singapore? It will be the foreigners, because they have no obligation to the country. And once they pack up everything and leave, this will affect the stability of the market, causing a knee-jerk movement, affecting the stability of the market. But if the market relies on the local demand, this will not happen. Because majority of the locals who purchase a property in Singapore is not just for an asset, it's their home. It becomes a necessity. So thus having more local demand in the area helps to stabilize the market. So what can we infer from this? We can be confident that the developers will be targeting and focusing more on the local demand rather than the foreign demand. Because due to the cooling measures, majority of the foreigners has left or is not enticed or is not tempted enough to buy a property in the Singapore market, especially in the CCR. So the developers have to price carefully because the developer is now relying on the local demand. They cannot inflate the prices too much. If they do, it becomes an unachievable goal for the mass market and the local demand. Also, that means the developer have to design the layout to suit the livability of the families in Singapore. Okay, so now let's move on to the supply in 2026. One of the latest CCR launches that we have is the GLS at Bukit Timah Road, right beside Newton MRT, with a whopping land bid of 1820 PSF PPR. So this is a very interesting bid for this GLS because there was a total of 8 bidders, signaling that this site is very popular. But if you look deeper, you can see that one of the bidders really wanted it more than the rest. HH Investments, where they bid 12.3% higher than the second bidder. And this became the highest paid PSF PPR and the CCR since 2018. And you want to know which project that was in 2018? It was none other than Cascadian Reserve at 2377 PSF PPR. And we've already briefly touched on Cascadian Reserve earlier, where they had an ABSD deadline extension and a relaunch with a lower PSF to sell all the units. So the question is, will this happen again to the Bukit Timah GLS too? Let me know your thoughts in the comment section below. So next we have Newport Residence will be launching in Jan 2026. And if you're interested and would like to know more, or if you want to see the show flat, you can book an appointment through me and I'll gladly give you my full analysis of the project. You can reach me through WhatsApp at 93690713. Okay, so more about this project is a redevelopment of the Fuji Xerox Tower, and it was initially supposed to launch in 2023, but of course, as we all know, the cooling measure was added in the same year, so the developers postponed the launch in hopes that the market will stabilize itself. So this project is particularly interesting because it is a rare freehold and in probably one of the most prime locations in the CCR, with just 3 minutes walk to the upcoming Prince Edward MRT, which targets to operate in June 2026. So my first impressions of this project is very clearly focused towards the investors rather for the own stay buyers. And you can also infer this based on the unit mix that they provide, where you see 1 betas and 2 betas make up about 79% of the total units, catering very little to the bigger unit types for families. So this development is targeted to investors and to a small pool of family buyers, the wealthy ones where the kids are grown up already. But let's focus on the investor side. Is the rental yield good, and is the entry price fair in the market location? So the estimated launch PSF is around 3,000 to 3,500 PSF. Total units 246. So let's find some nearby projects to do a comparison if the rental yield is good. First we have Arronte, which is not so far from Newport and is closer to Tanjung Pagar MRT. The distance would be similar to the distance from Newport to Prince Edward. So the average monthly rent for Arronte is in a range of 5,000 to 11,000 depending on the size of the units, which is expected in CBD. But let's see how the property value holds up. So in this slide, you can see the value of Arronte, and this is what you don't want to see happening in your project. The value somehow is declining. In 2010, it's around 2,400 PSF, and now it's around 2,000 PSF. So this led to many losing money once they exited their property in Arronte. But the question is why? I believe this happened because those buyers entered at a wrong entry price. Back then in 2010, they got it at 2,400 PSF, which at the time was way above the market rate. Another factor was the demand of the project. It was not as good as compared to the surroundings. Arronte felt very cramped and the amenities provided were on the smaller side compared to its neighbours, so the demand wasn't as great. So with that said, let's take a look at its neighbours. Icon Village, literally right in front of Arronte, the monthly rate ranges from 4,000 to 6,800. Not as good as Arronte, but let's look at the property value over time. You can see that appreciation is a lot better than Arronte. Not great, but still did perform better. Reason being is because they had bigger amenities, the development didn't feel so cramped, and the entry price was on parallel to the market rate back then. So actually this resulted in people still profiting from development. Even some walked away with $1 million in profit. So now let's compare to another project that's literally side by side with Newport, and is more recent too. 1 Burnham, where the monthly rent so far on contract was around 5,000 to 8,000. 1 Burnham was launched in 2021 with an average of 2,600 PSF. So the question is, could you use this PSF as a benchmark for Newport residences? But before that, let me tell you a secret. 1 Burnham was launched in 2021, but it only completed its sale early in this year 2025. Why? Because they had a CNY promotion, and all these promotions and fire sales, so to speak, only leads to one thing: initial wrong entry price. The developer's profit margin was too high. If not, how can they have this fire sale? Because no developer will lower their price to the point where they make a loss. So all this promotion just lowers the profit margin of the developer. So with this lowering of profit margin, the PSF from 2,600 was lowered to 2,400, resulting to a discount of up to $830,000, which is something that you don't want to see as an early buyer of the project. So again, it was wrong entry price for 1 Burnham, but let's actually see why. When they launched, there was a cooling measure and it also was not at the market rate price. So based on a land bid price of 1,463 PSF PPR for 1 Burnham, the estimated break-even would be about 2,100 PSF, where the selling price with around 15% profit margin would be about 2,430 PSF. And take note that there's a cooling measure implemented, so 15% profit margin was like a 50-50% chance whether the public will buy into the project or not. And when there's a 50-50% chance, the only way to make the public buy into this project was to make it appealing to them. So much so that they see that it will be worth into entering their project. So the question is, how do you make this appealing to the public, other than the pricing? It is by providing amenities that's favorable to them. But the thing is, for 1 Burnham, the amenities were not so tempting because surrounding resale projects had better amenities and lower entry price. And the worst thing is, those better projects were launched not too long ago. So that means that the design was still somewhat modern, had better amenities, and had a better lower entry price. So to the public's eye, it was not worth the investment to go into 1 Burnham until they changed the entry price, which made it more tempting, so much so that the public felt that it is worth to enter into the project. So you can see in this chart, majority of the units purchased were in the start of 2025. So this just shows you the importance of a good and fair entry price. And if you want to know the steps to analyze whether a project is a good and fair entry price, you can watch my video here, where I go through in detail the tools and methods for you to do your own analysis. So to conclude, the first impressions of Newport residents for an investor, you get a good rental yield, and with it being a mixed development and 3 minutes walk to the nearest MRT and having portside and a city view, how can your rental not be good? But just take a note of the entry price. All of it doesn't matter if your entry price is not good. You might win the rental yield department, but your appreciation value of the property you will lose. So with that said, the indicative PSF of 3,000 to 3,500 for Newport residences, do you think is fair? Take note that this is a freehold development, so with the additional 30% PSF, let me know your thoughts below. Do you think it's fair? Would you buy into this project? Okay, moving on, we have the next GLS site, Dunnan Road, near to Turf City, with a land bid of 1410 PSF PPR, with a break-even of 2558 PSF. Estimated number of units 370, where I believe the average PSF launch will be around 3300 PSF. And with many schools nearby and the close proximity to the MRT, it's no wonder the site is so popular amongst the developers, where you can see there's a total of 9 developers bidding for this land. So the reason why I believe that this is so popular amongst the developer, because the developers see potential in this site, where they might be targeting towards wealthy families with schooling children. Because the number of schools nearby are many, and they are good schools, plus you have the convenience of the MRT nearby. So it's an added bonus for parents because their kids can settle their own transportation to school. Okay, next we have the Holland Link GLS, which is also very near to the Dunnan Road GLS. However, this site is a little bit less accessible. This location is quite deep into the landed enclave where there is little, I think no bus services actually, but it's in a prime location. So it's like a very ulu but very prime location. So it feels like it's neither here nor there. The land bid is 1432 PSF PPR, which is just slightly higher than Dunnan Road, which is interesting to me because in terms of location, I feel Dunnan Road seems to be a better location compared to Holland Link GLS. And if you look closely for the bids for the Holland Link, the winning bid came in 22.2% higher than the second bidder, which could be a sign of overbidding. But let's not judge based on this. I'm interested to see how the developers can price this project competitively, especially with Dunnan Road site nearby, and even more so if they launched it at the same time. Last, for the 2026 CCR supply, we have River Modern. And here is why I think River Modern is probably going to be my top choice for the CCR new launch in 2026. So once you compare to the land bid of the other GLS and analyze what the location has to offer, you start to feel like this project at River Modern becomes more of a bargain. River Modern land bid was 1420 PSF PPR compared to Holland Link 1432 and Dunnan Road 1410. And River Modern's break-even will be lower than both Holland Link and Dunnan Road, meaning to say the developer's profit margin is around the same. River Modern will have the best deal out of the three. But I do see the developers pricing River Modern with a higher profit margin. Because of what River Modern has to offer, the developers Guacoland will probably price it higher because the demand of the location is good. Reason being because River Modern has a lot of mass appeals. The location is amazing, it's in the CCR beside Great Wall Mall. It's a mixed development with good amenities and integrated MRT access. So convenience is there. And it's also right next to River Valley School. And on top of that, you're overlooking Singapore River. So it won't be a surprise to me if Guacoland actually prices above the average PSF in CCR. So if that's it, I believe the River Modern's PSF, indicative PSF, could actually reach around 3100 PSF, reaching towards 3200 PSF average. The reason why I say that is because we can take Zion Grand as a case study. During one launch weekend, over 84% have been sold, where the demand came from families that favor integration to the direct MRT access and also the location of River Valley. So I do believe River Modern will follow in the footsteps of Zion Grand. So if you'd like to know more about this project, you can reach out to me, as the preview date for this project will be located on the Feb of next year 2026. So for the overview of 2026, there will be a total of 4 GLS with a total of 1310 units, but if you include Bukit Timah GLS, it will be 1641 units in 2026. But just take note that this Bukit Timah GLS could actually be a 2027 supply, depending on when the developers can get ready for its launch. But with that said, let's see how this supply will impact the market in 2026. So now let's do a quick calculation to predict how the CCR market will be like. So let's take the total supply minus the average transaction volume across the 5 years. We have 61% take-up rate excluding the Bukit Timah supply. Including the Bukit Timah supply, we have at least a 48% take-up rate. So in general, demand will be moderate and healthy, meaning to say that the market could stabilize itself, where you don't see too much inflated prices because the supply is sufficient enough to meet the demand. Where there's an oversupply, the chances of the market dipping or stagnating will be higher, as it will be very competitive. But let's say if the supply were to be around the same as this year, around 1000 to 1200, but let's say 1000, the take-up rate would be 76%, with a remaining 300 units in the inventory of 2026. So if this were to happen, the prices in the CCR will most probably shoot up. And this will occur not only in the new launch market, but also in the resale market too. And then you'll start to see the price gap between the CCR and the mass market start to widen again. And to be honest, you can actually start seeing the signs of this happening, where you have Bukit Timah JRS, where the supply is not sufficient enough, so the developer becomes more aggressive in their bidding, resulting into a higher launch price eventually. So now that we have covered the 2025 CCR market and also the preview of the 2026 CCR market and how depending on the demand of 2026 it will affect the PSF and quantum. So I'm pretty confident that the PSF and the quantum will increase. The question is, how will this affect the resale market of the CCR? We will start to see resale projects also increase due to the new benchmark set by the new launches. And also remember, with this new CCR benchmark, the price gap between the CCR and the mass market will become significant again. That means we'll see less upgraders entering into the CCR market. And this could potentially bottleneck the people who wants to go into the CCR region. So now let's dive into the resale market of the CCR. In this slide, you can see the resale market of the previous years, the green in the CCR, the blue in the OCR, and the red in the RCR. But for this video, let's zoom in into the CCR transaction volume. So if you compare 2025 and 2024 resale, you can see that 2024, the resale volume is higher than 2025. Reason being because the supply in 2024 was lower, so the buyers couldn't find their desired unit, so they had to swing into the resale market. But in 2025, you can see less transactions happening in the resale market because the supply in 2025 is higher and also sufficient enough to meet the demand. You can see in 2023, it's almost a similar case in 2024. The supply was low, they had to swing into the resale market. Then you might be wondering, by that logic, high new launch equals to low resale, then why is 2021 supply high and also the resale market was also high? So the reason for this happening involves many factors, such as the lowering of interest rates, the COVID pandemic boosting the property market, and more importantly, the market did not react to the cooling measures. So actually a large portion of the demographics in the CCR were foreigners. But once you see the cooling measures take place, especially in 2023, you can see the transaction volumes in both the resale and the new launch drop, meaning to say that most of the transactions made after 2023 were coming from the local demand. So with that said, the 2023 and 2024, the total transaction volume both in the resale and the new launch did not hit above the 3,000 transaction mark. But you can see that in 2025, the total volume of the resale and the new launch transaction went above 3,000. So this is very clear cut, guys, that the demand in the CCR is definitely returning. So guys, with the new launch supply in 2026, if the demand is the same in 2025, I do see a lot of people will be swinging into the resale market in the CCR. With that said, it could be a good time for the sellers to exit the property, selling it at a higher price due to the limited amount of supply. And as a bonus for the sellers, because of these new benchmarks that's being set, you can potentially increase your selling price too, allowing you to have a bigger profit. But how to identify the benchmarks and when to exit at a high premium is something I believe is crucial for a seller and a buyer to be aware of before they make their decision to exit or invest. So it's pretty simple if you use this framework, the GTA. G stands for GRS, so is there any GRS near the location where you live? If there is, how much did the developer win it for? And what is going to be the break-even price? That will give you a benchmark as to how much you can push your property value to. Then you have T, transportation transformation. So this means, is there any transportation hub, node, station that will be constructed near you? Essentially transforming the convenience of the location. Then last you have A, appeal. So what's going to be the appeal to the masses? Is there going to be a new shopping mall? Is there going to be a new school, new hawker, new grocery store, a revitalization of an old shopping mall? So these are all the appeals. In general, these are the three major benchmark indicators. Once you identify which indicators you have, you can dive in deeper. And let me show you how. Just remember this, ACC, which means announcement phase, construction phase, and completion phase. That's why ACC. So announcement phase is when the public gets informed of the new possible launch or the new possible transportation hub or the new possible shopping mall. Then construction phase is when you actually start to see the project move. You can see the construction, you physically see the progress happening. And then completion is when the project is done and is ready for the public to be used. It becomes an integration of the community. So let's go through some examples. For GLS, let's have a case study. Rivergate, a freehold development at River Valley that was completed in 2009. And the new GLS site will be Martin Modern. The development is located literally side by side of each other in a prime location of River Valley. So let's just see how this GLS affects the Rivergate, which I have to say is one of the most beautiful condominium projects in Singapore. If you don't believe me, just go Google Rivergate, start to see the landscaping. It's very nice. If anyone's interested, I believe there's some 3-bedders and 4-bedders available. If you want to see more, you can contact me. I'll show you around. No harm, it's free anyways. Okay, so now let's go through the ACC for Rivergate. In 2026, the winning bid for Guaku Land was a record high at 1239 PSF PPR, which means that the break-even will be around 2200 to 2300 PSF. Just the break-even alone actually set the benchmark high in that location. So that made many investors and owners of Rivergate realize that, hey, this 99 leasehold value is much higher than my freehold property, and it's also within the same location. So something's not right. How can a freehold be of a lesser value than a leasehold? So with that mindset, the owners of Rivergate naturally will price their prices higher, and also the investors who are looking into Rivergate are willing to pay at a higher price. Then the construction happened in 2017 where Martin Modern was launched at 2250 PSF. So with this confirmed price, this gave Rivergate sellers a confidence to increase their selling price around the same of Martin Modern, which is around 15 to 18% appreciation for Rivergate. Then once Martin Modern was completed and TOP, the units were selling at 2800 PSF. Because it was a brand new and it was ready to move in, there's no need for you to wait. Naturally, just push the PSF high, around to the same PSF level as Martin Modern. And for those of you who are wondering how come the Rivergate's average PSF is not the same as the Martin Modern PSF, especially since it's a freehold. So what you need to know is that PSF and quantum are completely different. Rivergate was completed in 2009, which was an older development, so generally the sizes of the units are bigger compared to Martin Modern, where it's more efficient in their layout. So even though the PSF for Martin Modern is high, the total quantum could be actually the same. Actually, Rivergate might even be more because of the sheer size of the unit. So even though Rivergate PSF is lower, because of the size, the quantum is probably more than Martin Modern. So with that said, the owners of Rivergate cannot price the PSF too high, because if the PSF is too high, that means the quantum will be way higher than Martin Modern, and that will lower the demand for the Rivergate because people will not be able to afford the new price of the Rivergate. So in this next slide, you can see the value increase during the ACC phase. For this, I tried my best to compare to similar units type and in the same stack, which is a 2-bedder at stack 16 in Rivergate. So as you can see in 2010, during the pre-announcement, a 2-bedder unit was at 1776 PSF, then increased to 1990 PSF in 2016. Even though there is a 2-floor difference, so usually per floor jump is around 8 to 15 PSF. So even if you minus 30 PSF due to the 2-floor difference, that's still around 1960 PSF. Then you can see the same unit, 14-16, in construction phase was at 2453 PSF. Then in completion phase, increased 2983 PSF. So you can see how the unit appreciates during the ACC phase, resulting in the profits up to $1 million. So now let's move on to the transportation transformation. As case study, we have the Equatorial, a freehold project built along Bukit Timah Road. It was completed in 2001 and is right beside Stevens MRT. Super good location in prime Bukit Timah address, but the transportation convenience only came in much later after the condo was completed, because the downtown line was completed in 2015 and then the Thomson East Coast line was completed in 2022. So this is a perfect case study for this transportation transformation. So going through the ACC phase, you can see that in 2018 was the announcement of the downtown line Stevens MRT. So before that, the Equatorial was trading units around the 1000 PSF, where in June 2007 some units were sold around, where in June 2007 some units was transacting at 1102 PSF. On the announcements phase, it increased to 1200 PSF. Then in 2010, the construction phase, it kicked in, and between the construction phase and the completion phase, the average PSF was 1400 to 1700 PSF range. And finally, the completion in 2015. But there were no sales in 2015 due to the cooling measures, but when 2016 came in, it started to pick up again. So in 2016 onwards, the PSF was from 170 PSF all the way to 1900 PSF and above. So in this slide, you can see that before the announcement, the appreciation wasn't very steep, but afterwards it got steeper. But you need to remember that Stevens MRT is a dual interchange. So the baseline at that time, Stevens only had Downtown Line station. So the prices were already healthy, but not like interchange level yet. So currently now Stevens MRT is a dual interchange, but back then it was only Downtown Line. If I recall correctly, a unit sold in November 2012 was around 1718 PSF. So the construction phase of this Thomson East Coast Line in 2015 actually helped to hold the price of Equatorial, because back then there was a cooling measure where many saw a dip in price. But because people knew that this is going to be an interchange product right beside Equatorial, the prices actually didn't decrease, but instead it held its price because investors saw the potential of this product. Then in the completion phase onwards is where you can really see the full effect of the transportation transformation, where in 2020 it jumped from 2100 PSF now to 2600 PSF, which you can see in this slide. Notice how the Downtown Line and the Thomson East Coast Line interact with each other, and you can see in 2012 the appreciation became steeper when the Downtown Line was constructing and the announcement of the Thomson East Coast Line was made. Then from 2022 to today, 2025, the PSF skyrocketed because of projects such as Equatorial in a prime location, just 2 minutes walk away from an interchange station, becomes very rare. So that resulted in many earning profits hitting 1 million, 2 million, and all these are in profit. Then now let's move on to the appeal, where we will be using the Cosmopolitan, a freehold project completed in 2008 as a case study, and the appeal is the shopping mall Great Wall. But for those of you who actually know the history, you will know that this mall existed way longer before the Cosmopolitan. So originally the site was developed as an amusement park. It was called the Great Wall Amusement Park and was up and running from 1929 all the way to 1978, where it undergo a redevelopment and became a shopping mall called the Great Wall City, which was completed in 1997, and it operated all the way until 2018, where again they did a major renovation, and once the renovation was done in 2020, it's called Great Wall. So the site had undergone major transformations not once, not twice, but actually 3 times. Reason being is to appeal to the masses in the surrounding location, to cater for the demand of the surrounding people in the location. And trust me, if you continue to stay as an amusement park, the demand of the location will drop significantly. Reason being because there is no appeal to the masses in the location. So that's why they redevelop into a mall. Then people start to see the appeal of the location again. But then you start to see in the 2000s that the appeal of the mall starts to drop. Why? Because not too far away you've got places like Orchard, City Hall, Bugis, where all the malls are newer, better, more modern. So what happened next? The next round of transformation occurred, which eventually became Great Wall. And now the people living there are happily using the amenities in Great Wall. So let's see how this transformation actually increased the value of its nearby condos. So let's see how this transformation actually increased the value of the Cosmopolitan. In this slide, you can see the 2017 announcement made. Before that, many of the 2 bidders were transacting at an average of 1900 PSF, and very few units managed to break the 2000 PSF mark. But once the announcement was made, a lot more units were managed to break through the 2000 PSF mark. Eventually, during the construction, despite the noise, the inconvenience, many buyers were willing to pay a premium because the demand for the appeal was there. They knew that the revitalized shopping mall will be completed soon. Then the completion of the Great Wall. New shops started to open to the public, competing with outlets that are available in the main shopping districts like Orchard, City Hall, and Raffles City. That made the value of Cosmopolitan increase. So now take a look at this. You can see the appreciation during the ACC phase. For units 15-01, it was sold before the announcement at 1900 PSF. The same unit was sold again at 2551 PSF during the construction phase. And later, a similar unit 13-01 was sold at 2323 PSF after the completion. And this unit is 2 floors below. So if you reset to the same floor and add around 30 PSF, it's actually even higher. That's why you can see the profit amount for this project is in the million range. So again, this is the framework that you yourself can use to have a guideline as to what to expect if you are a seller or you are a buyer, and ask yourself, where does this fall into the category of the framework? But of course, these are just the major guidelines to see the appreciation timeline of a project. If we had to go into detail, there'll be a lot more factors involved. For this, we use a different set of tools called Compass 10. So just to quickly brief you, Compass 10 is a tool that we use to evaluate in detail the qualities of the project. It measures up to 10 factors and review how the project performs in each factor. So all we need to do is we type in the development we want to review, and it will score accordingly to the 10 factors. So if you want to know the 10 factors, you can pause this video here and you can read through all the 10 factors. So the Compass 10 will rate them accordingly and give you an overall score that will judge the characteristics of the development. So even after using the GTA framework, if you are serious about your potential purchase and you need help to review further, you can contact me through WhatsApp and we can use this tool together to help give you more confidence in your next purchase. So to conclude, if you're watching this video and you catch no ball, here are some takeaways for you. First, the supply in 2026 is lower than 2025. And if the demand will be the same as 2025, that means there'll be a shortage. So the demand outweighs the supply. So some projects to take note of to have a rough gauge of the demand in 2026 are Newport Residences and River Modern. These projects will definitely give you an idea of the demand in 2026. Second, which relates to the first takeaway, if the demand outweighs the supply, then you could see an increase in the quantum in both the new launch and on the resale market. So this will widen the price gap between the CCR and the mass market. So there may be a bottleneck for those who want to upgrade into the CCR. But with all that being said, there is still hope if you act fast, because there will be a small lag window before the market reacts to the demand and increase their prices. And the third takeaway, you'll see more people swing into the resale market again, which will set a new benchmark, so you need to act fast. But with that said, acting fast doesn't mean you act recklessly. You still need to do your own analysis. I do feel that the CCR market will appreciate in price, but it will not go up significantly. It will be a modest appreciation. Reason being is because the CCR market in 2026 will be driven by local demand. Ever since the 60% ABSD for foreigners, more buyers are coming from the local rather than from the foreigners. So for most local demand, the affordability and the livability matters the most. With that said, I believe we will see inflations in the CCR at a modest 2 to 3%. So guys, it's very important for you to do your own analysis and your own homework before purchasing a property. Even though you feel like you need to act fast, making a mistake will cost you more. So thanks again for staying to the end of the video. I hope this video was fruitful and hope it helps you give a rough idea of what to expect in 2026. And also for you to use the framework, the GTA, to help give you an idea of benchmark of when is the right time to enter the property or let go of the property. Okay, thank you for staying to the end of the video. I hope this video was fruitful for you, and I'll see you in the next one.